First of all, great to see so many people here today in the audience. Well done for making it on a very cold and miserable London day to attend this seminar. And first of all, thank you to Jim and to John for a really fascinating keynote interview. I think it just goes to show there's a lot of investment required in the grid to support a green modern economy going forward. So thank you and well done. And you've set a very high bar for the rest of this evening. I prefer to be a limbo dancer, but there we go. But anyway, so in this next session, as Fraser said, we're going to be covering the topic of allocations to listed infrastructure. I think there's a recent stat in GLIO that I think from 2010 to 2021, we've seen an exponential rise in the amount of capital in the space. It's gone up from something like 10 billion to around 145 billion in the last 10, 12 years. So what does the future hold? What's been driving this trend? What does the outlook look like for listed infrastructure post-LDI? How important is it to stay liquid? What's the outlook now in a higher interest rate world, now that cheap money is perhaps gone? So with that, I guess to discuss that and more, as Fraser said, great to see Tom and David here on the panel. Perhaps just to kick things off in terms of allocations to listed infrastructure, and in terms of any particular trends we've seen in the last 12, 24 months. I think anything discernible that we're seeing, anything changing? Tom, do you want to take that on to kick off?
I can start. So I think we've definitely seen that increase in exposure to real assets, and within real assets, listed real assets, and within listed real assets, listed infrastructure. I think investors of all stripes welcome the diversification benefits of that sort of exposure. There is an understanding and a recognition of income generation, lower volatility, and exposure to assets that are otherwise difficult to gain exposure to elsewhere. So over time, as portfolios have evolved from more simplistic equity and fixed income portfolios, real assets has seen an important role, and in our view, it's a strategic allocation as part of a total portfolio. What you raise is interesting in terms of the listed infrastructure characteristics and the particular growth in that market. I think investors have become more aware of the impact that their investments make in the real world and the impact that capital allocation can make to local communities, to users of those investments, and in our case, in real assets, in infrastructure. So I think as sustainability and ESG considerations very much come to the fore of client and investor considerations and discussions, infrastructure in its broadest sense and listed infrastructure in its most liquid sense plays a really important part to tangibly impact and deliver on sustainability objectives of all investors. So I think definitely that's been a central evolution that we've seen in recent years. And when you combine that with groundswell with respect to net zero and decarbonisation, then there's a great alignment there on investors' ability to support that evolution.
And to just pick up on that, WTW, you look after investors allocating to listed and unlisted infrastructure. Is that fair to say? And is there any discernible trend in terms of between the two? And are there particular types of investors, or is it pretty secular in terms of which type of investor can choose listed over unlisted?
Sure. So WTW is an investment firm that provides strategic advice as well as delegated investment services for a whole range of clients all over the world. We have delegated assets under management north of £150 billion and assets under advisory significantly in excess of that. So we have clients of varying governance levels, and clients with different objectives who are in different phases of their investment journey, if you like. So some of our investors are frankly not interested in listed infrastructure because they are of the scale and size where they feel that an purely unlisted exposure is an optimal way to access infrastructure. But we also have lots of clients who seek a strategic exposure to infrastructure and maybe don't have either the governance or the time horizon or the fee ability to access unlisted infrastructure. And so listed infrastructure provides a great way to gain exposure to that asset class in a more liquid fashion, in a cheaper fashion, and meet their portfolio ambitions. So we have a spread across listed and unlisted, and then within listed, there's a whole range of ways in which investors can access the asset class, right? So Atlas's portfolio is rather more concentrated than other portfolios might be, and that suits the need for some investors compared to others. Part of our advice to clients pertains to what you are seeking to achieve from this exposure, whether it's more simplistic exposure to infrastructure or whether you are more targeted in your ambition. You might have explicit sustainability goals that you might want to achieve from an allocation to infrastructure. So there's a real variety there, and it can get quite client specific as to the aims for an allocation to infrastructure and listed infrastructure within that.
Very good. I guess it'd be good to bring David in, and just in terms of your perspective at Atlas, in terms of what you're seeing as far as allocations are concerned.
Yeah, we as Tom mentioned, so just as a bit of context, we're not necessarily a household name. We're about 5 years old. We're a dedicated listed infrastructure manager, but we sit under Global Infrastructure Partners, which is maybe quite well known in the unlisted market. I guess as Tom was saying, we're seeing obviously it's a bit different depending on which investor you're talking about, but maybe at one end of the spectrum, what I think is quite interesting is the more mature people who have been in the infrastructure market for a while, even those for whom like the unlisted market is maybe all else being equal, kind of the preferred approach, they're really starting to find, as more money has moved into the infrastructure sector in general, they're really starting to find it quite difficult to find just good quality assets at a good price. And so particularly guys like the sovereign wealth funds and some of the more sophisticated investors, and what we find is quite interesting is really using the listed infrastructure market quite opportunistically. So if you either have a great advisor or you have a big internal team that really understands infrastructure, the listed market really becomes just another place to potentially deploy capital. And you can kind of screen the universe from its 300 stocks down to a preferred list of 10, and you might take stakes in 2 or 3 companies. And the great thing about the listed market, as opposed to the unlisted market, the only way you're going to buy an asset basically is to destroy yourself in a data room and pretty much either have unrealistic expectations or a very low cost of capital. The listed market spends significant portions of its time being irrational, either pessimistic or optimistic. And one of the things that a number of our clients have had success with is really utilizing that irrationality to find good assets, either use it as a great entry point, and from time to time actually exit assets, which I know they're not really always that keen to do because it's sort of anathema to building a big infrastructure portfolio, but the listed market can do that. So that's kind of at the really sophisticated end. Maybe at the other end of the spectrum, what we're seeing is we're seeing some of the sort of small to mid-sized pension funds. They got this allocation of infrastructure maybe 5 years ago or 6 years ago when infrastructure was starting to become a thing, and they're like, we talked to a few unlisted managers and we made some commitments, but they're taking a while to draw down. and maybe we can get to liquidity in a second, but some of them are getting a little frustrated and starting to look around for other options just to access the space. Now we've got actually one of our larger clients, to be honest, they kind of use us as a parking space because, well, the funny thing is actually they've put money into listed infrastructure market as a parking space, but found after some time of being exposed to the asset class that actually it's generated some pretty good characteristics, and it's an awful lot better than having your funds in the general equities market, especially last year. The final thing I guess I'd note is, we were the listed infrastructure market was kind of a bit unsexy there for a while, particularly in 2021. The equity market on the back of some of the tech stocks was going bananas. The listed infrastructure market lagged by 10%, and you can talk to people about inflation protection and defensive cash flows and bond rate protection until you're blue in the face. But when Facebook is going up 20%, people are like, yeah, okay, come and talk to me. But they always only come and talk to you after that correction's happened. But not that I'm complaining. But we are starting to see the great thing about listed infrastructure in the last 12 months is it's done exactly what it was supposed to do, and it's thank God that kind of it's all held up. The cash flows have held up really well. The assets have part of the reason that it held up so well is that despite the inflation spikes and bond rate spikes, the cash flows have actually come through, and so infrastructure was pretty much flat for the year against an equity market which was down 15%. And that's it really helps to have that proof point when you go and talk to your clients. And I think that's generated some conversations as well.
Very good, very good. You mentioned that there are some investors, like the sovereign wealth funds or experienced unlisted investors that are seeing listed as a parking space or opportunistic. Be helpful also is it fair to say Australian market is a fairly developed one? They see listed as a source of completion to the overall infrastructure portfolio?
Yeah, definitely. The Australian market is definitely probably more, from an infrastructure standpoint, quite a mature market. I think part of that, to set a bit of context, part of the reason for that is that the Australian market is much more heavily DC, and so you kind of need when you have a heavy DC proportion of your portfolio, and we can get to liquidity in a second, but you do need something that's a bit more liquid in your portfolio. So you've got that element. You've also got the element that infrastructure has just been a part of people's portfolio for longer. So there's a maturity to it, and really it's this sort of happy sort of circularity that we had lots of infrastructure managers. They spun off and did listed infrastructure as a product. They sold it to some of their clients, and a lot of the pension funds have just, it's become part of just what they do. The UK market is actually maturing quite quickly. The European market on the pension fund side is, there's many more rules about, if this is private, if this is infrastructure as private market, is infrastructure as private market, and never the twain shall join. But we're starting to see some changes, especially again as DC sort of comes through. But definitely the Australian market is a pretty good. Well, hopefully it's kind of a nice indicator of where things can go as the market matures.
You mentioned, David, about listed infrastructure being flat for the year compared to equities. Quite often when we talk about listed infrastructure, the topic naturally veers to performance compared to unlisted infrastructure.
We've put up a chart there, Anish, by the way.
Yeah. Perfect timing. So is that, perhaps I'll turn to Tom, is that something you look at closely? Is it a fool's errand comparing listed and unlisted from a relative value perspective?
I don't think so. I mean, I think a lot of unlisted market participants look at what listed infrastructure does to try to divine a broader view on the market. Something that came to me when David was speaking was that actually what we've seen over time with unlisted infrastructure is a broadening of what constitutes infrastructure, whereas investors have been able to get a very core exposure and consistently core exposure to infrastructure through listed markets. So we look at relative value, yes, but we look at relative value for those clients for whom it is appropriate. And it's true that there are some assets in listed infrastructure that are very difficult to get exposure to in unlisted markets, and to some extent vice versa as well. So there are some clients that use listed and unlisted and sort of toggle those to optimize their allocation. The defensive nature of listed infrastructure over the last year can also be seen as a negative for listed infrastructure, because suddenly on a relative value basis compared to lots of other asset classes, it's perhaps not as compellingly underpriced as other sectors or asset classes might be. We see this sort of structural valuation differential between listed and unlisted, much to the disappointment of David and his peers. Quite what's driving that is a subject for many hours of discussion. So I think the relative value of this stuff can also be joined with a discussion on volatility tolerance as well, right? And I think that a lot of investors in unlisted markets appreciate the valuation infrequency of those exposures because they serve a sort of purpose for their overall portfolios right now. Over the long run, that correlation diminishes, right? And we see listed infrastructure, just as listed real estate, deliver exposure that is equivalent to unlisted over the longer term, in the main, right? So yeah, I think the other aspect of the current situation when we consider relative valuation, which we didn't necessarily major on to begin with, but you raised, was inflation protection. We live in a world today of elevated inflation, which may or may not be stickier than people might assume it to be. And so there is appetite for exposure to asset classes and investments that can deliver inflation linkage in their cash flows, right? And listed infrastructure is one such area, and different clients will value that inflation linkage differently. But certainly that is a key consideration when we're considering that relative valuation and how much you're paying for an equivalent exposure in private or public markets.
You mentioned the stickiness of inflation. Each bout of inflation has its own drivers, as we're seeing, and to some extent that's being driven by commodity prices. Do either of you see much interrogation, probing, or comparison of actually listed commodities versus listed infrastructure as a proxy for inflation linkage?
I mean, yes. How's your tolerance for volatility? It's kind of, they're just sort of just different horses for courses, I guess. What I think the way of seeing listed infrastructure is that it's a defensive set of future cash flows with pretty good growth that has bond rate, not just in commodity protection, but it's got bond rate pass through for most assets, or for a lot of assets as well. It's actually, it does have those real assets, and inflation protection or inflation linkage is a useful characteristic of it. I don't know. It's not the. You can, I guess, construct a portfolio of assets that really have almost linear pass through, but it's you could either do commodities or you could do gilts. There's a few other ways of doing it. I think this is kind of more an asset class that gives you a level of protection, but with a whole bunch of other characteristics. Inflation protection is just is a nice way to be confident that your investments won't be undermined in real terms by a bout of inflation.
Yeah, I think from the work that we've done on commodities, they can work for certain periods of time over the long term as a sort of strategic exposure. It perhaps doesn't necessarily give you all of the characteristics that you might be seeking from what do you put that in, a real assets exposure. So whilst there is merit for such exposure at the right point in time, capturing that right point in time is an art that not all can necessarily participate in.
We know how good investors are at timing the market. Yes.
Right.
Very good. We touched, I guess we said it at the top, we turned to liquidity. Perhaps it'd be good to, I know you touched on justifying listed versus unlisted or part of a broader portfolio. Be helpful to just share any anecdotes you've seen from the last 6 months, especially post mini budget, around I guess how investors have been treating listed infrastructure and thinking about access to liquidity.
Sorry. This is a good question for Tom.
So I think that we certainly live in a world today where liquidity is more valued by investors. I think that's fair to say. Some investors find themselves in a situation where they are, so if we take the UK DB landscape, which is a very particular investor type in a global context, but the UK DB landscape, you have clients that are either much closer to their time horizon buyout ambition than they thought they were, or others which, for whom it might take a bit longer. For those clients that suddenly find themselves with assets that are rather closer to their liabilities than they thought they were, then de-risking becomes a much more relevant discussion. You also have investors who have invested very readily in real assets and private markets more broadly, who find themselves with equity and fixed income books that have reduced in value quite markedly over the last year, and private markets that have remained rather flat. And so they find themselves over-allocated to that part of their portfolio. So for a number of different reasons, you have clients that are looking for liquidity in their private markets exposures. And a lot of those are strategic. They are either strategically de-risking or strategically rebalancing their portfolios. We haven't necessarily had heaps of new inquiry on we need listed infrastructure in our portfolio. I think if you are needing to sell your private markets, you're probably going to wait for as long as you can before you do so. I think if you speak to private market participants out there, there are secondary funds that are licking their lips for what might be quite an active 2023. That provides opportunities as well. But certainly my expectation would be for clients to consider listed real assets as a means to continue that real assets exposure in a shorter time horizon as they approach their strategic objectives.
Yeah, that's pretty consistent with what we're saying as well. So a few elements. Well, liquidity is quite interesting, and it's nice to see it come up as something that is actually valued, as opposed to almost something that is bordering on a negative, which it has been for some. I guess it's more the valuation frequency rather than liquidity that's the issue, but they're obviously intertwined. We're definitely starting to see people who had, went from basically underweight infrastructure to now either at weight or overweight infrastructure very quickly in September. So, and as you say, who are either having to grow into their infrastructure, now overweight infrastructure allocation, or actually liquidate it at some point. We were talking to one of our clients today who has a pretty big infrastructure exposure, and they're kind of in that boat. Like, we're not kind of doing secondaries just yet, and we're not seeing too many, but it could be just a matter of time. The other thing is what we are just getting a whiff of, and I guess this more relates to the private market, but I think it's going to make private market fundraising rather challenging going forward. Now people are at weight. So one way to kind of get your infrastructure exposure, but if you're already kind of at weight in your private market, or private market allocation is to go in this direction. And then going forward, hopefully this can be used as a really good case study. I mean, I guess what we're saying to our clients is, okay, that's a really good learning point for going forward in your infrastructure allocation. It kind of makes sense to have 10 or 20% just sitting there. So liquidity has a value from a rebalancing perspective, but also, and maybe going back to the first point that I was talking about, which was how to use listed infrastructure more opportunistically. It also has just a tactical value as well, which I think often is misunderstood, not just from a seizing the opportunity between listed and unlisted, but actually just if you do have an ability to move quickly and understand the intrinsic value of these assets, just having the ability to move in and out of the sector. The good thing is it's not a sector where cash flows are fluctuating or future business plans are moving all over the place. So when we look back at the NAVs of our assets, they're pretty flat, and yet you see the share price kind of moving all over the place. And that liquidity enables good investors to generate excess returns even by owning the same asset 2 or 3 or 4 times. So it's good to see liquidity actually having there's a reason that they call it a liquidity premium. But we've had almost a negative liquidity premium in the market in the past few years.
Yep. I mean, you mentioned NAVs and cash flows are flat, but valuations have been oscillating. Why is that? Is it the market? Is there more the market can do to understand the fundamentals of stocks?
It's quite interesting actually, and Fraser's doing a good job at. I think initially we mentioned that this listed infrastructure market has gone from 10 billion to 150 billion or whatever it is. The total value of the market hasn't changed that much. It's kind of grown fairly organically, and we've added some assets here and there, and our friends on the unlisted side have taken some assets off us, normally the good ones, which is disappointing. But really what we're seeing actually is just a high proportion of the total market cap of these assets is increasingly being owned by, whether it's big chunks, 5 or 10% being owned by sovereign wealth funds, or it's, guys like us or some of the other more active managers. That the more, interestingly enough, the more successful Fraser is, the harder it might become to sort of arbitrage value opportunities in this market. Having said that, we're still sitting at something like 5% of the total market cap, maybe 7%. We might push up to 7% in some metrics, but really the market is being moved around by a whole bunch of other factors over which we have basically no control. And that's frustrating on a day-to-day basis, but actually, if it wasn't like that, we wouldn't have a job. We should just invest in in an ETF and go back to doing something else. So it's really the listed market is, as I mentioned, it's often exuberant or depressed, and that's a kind of a good thing. And I can't see that fear and joy going away anytime soon.
Yeah, I would say that sort of sector-specific anecdote is that you also have equity generalists who might perceive utilities as a bit of a bond proxy. And so as soon as you have yield volatility in fixed income, that then sort of passes through to some extent in share prices, sometimes irrationally. And given some of the attractive attributes of listed infrastructure in that they are monopolistic, heterogeneous, and you only tend to have one of them in any particular location, whenever you have news about things like transportation or air travel or electricity or gas kind of developments, then it's an easy way to play that news in the short term, as opposed to having a more longer term view on company direction. So I suspect that's probably some of it. But over the long term, we value that stable NAV growth and income generation as long-term investors for sure.
Great. Before we wrap up, conscious of time, do we have time for some questions from the audience? Gentleman over here.
Thank you very much. James Crutcher from CBRE Investment Management. It's been put to me a couple of times that historically the consultant community in the UK has been more reluctant to recommend that investors get their real assets allocation in the listed form than perhaps in other parts of the world. Is that fair? And if so, has it changed at all?
Hi, James. Interesting question. I can't speak for all the other consultants. But my experience is one where I have put some challenge to that notion that unlisted exposure is preferred to listed. And I think that's been received and listened to, certainly in my organisation. We have far greater listed exposure among our client base than we do unlisted. Sort of in the main. But I think you're right that there's generally this perception that there's this tangible or rather material illiquidity premium in unlisted markets which delivers over the long term. And I think you mentioned this earlier, that sort of that's been challenged a bit in recent times given the performance of listed real assets. But I think there is a control premium in unlisted markets where you can more actively drive initiatives for change and repositioning and value creation. So that's not to dismiss unlisted investment, because you can certainly generate material value on the unlisted side. It depends very much on your investor type and the sort of time horizon and tolerance for volatility and tolerance for illiquidity that you have to kind of direct you either way.
If I can I'm going to piggyback on the back end of that. Obviously, yes, I probably agree that the local consultants are, in our experience, some of the larger ones. Obviously Tom's been a good supporter of listed over the years, and some of the big consultants are, almost necessarily have to look at the space. I think it may be some of the more niche guys, haven't really embraced it. But going back to Tom's point about the control premium, I think it's pretty much the key. That's the key point. I think these things should be seen for what they are. Like, there's no point paying 1.5% or 2% management fee and buying an asset where you've got stable regulation and you're not really going to do much aside from maybe talk to the procurement guy occasionally. It just doesn't make any sense. So in our view, listed actually, and this actually goes to what we focus on as well with our portfolio, which is, I think our job is to find good core infrastructure with good management teams where actually you don't, with some exceptions in terms of interaction with management teams, 90% of it's there. The private market actually is a great place to find good assets with terrible management teams, or that are doing turnarounds or split ups or recontracting or development projects where you do need really hands-on from the investor. That's where actually the private market shines, and where actually they earn their fees. Paying 1.5% to a private equity infrastructure manager for a core exposure often makes very little sense to me, just from a fee perspective. Like, what are you guys doing aside from overpaying for an asset?
I mean, maybe I pick up on part of that as well, as I guess as a consultant too, in terms of, I guess, a certain thematics in infrastructure where there's perhaps quite a bit of, especially the sustainable theme. I look forward to the next panel, and it was fascinating listening to the keynote earlier. Arguably, in listed, stand to be corrected, arguably I think for the median investor, many of them want to do and show something very tangible from a sustainable perspective, and that's possibly easier to access in unlisted than listed, where there's more. It is there. I think the sustainable opportunity set is there, but is arguably more nuanced in thinking about. Clearly, there's a lot of there's a big sustainable angle to national grid, but you perhaps need to look much under the hood around what they're doing around that, as opposed to taking development and construction risk of an offshore wind farm, which an unlisted manager would be doing. So I think there's also perhaps a dichotomy there where investors maybe want to do something very tangible and show something, put a nice big picture in their book, in their annual letter to trustees.
I think
We own this wind farm.
I think that's going to be really interesting to see in the next 5 to 10 years as there comes pressure from investors to disclose and engage with what you are doing from a sustainability perspective. And the public markets are obligated to report a lot more than private markets are, right? And so you can have some management teams or asset owners or investors who perhaps rest on their laurels that they own a good asset and that's okay. But we're now getting to a stage where disclosure of sustainability considerations and engagement activities and stewardship at the underlying investment level is becoming central to investors' decision to invest or not, right? The amount of heat that I get for listed infrastructure screens high from CO2 emissions is regular. But it's a journey there, and there's a broader discussion around what listed infrastructure does over time to enable an electrification, for example. And I mean, we're not going to go down the rabbit hole now, but there's a whole range of positive reasons why holding a listed infrastructure allocation now makes sense for the future, specifically from a sustainability standpoint.
Do we have time for any more questions?
I think we should probably invite Matthew and the ESG panelists up, Guy
Very good.
and Georgia. It's a nice segue into the discussion, I think.
I think so indeed. So, well, look, thank you everyone for your attention, and thank you, Tom and David.
Thank you.